Welcome to Finsights, your go-to channel for all things finance and investing. Whether you're a complete beginner or someone looking to sharpen your investing skills, this video will guide you through starting your investment journey with just $100. Stick around as we break down complex concepts into simple steps so you can confidently start growing your wealth. Let's begin with the basics. Why should you even consider investing your hard-earned $100? Simply put, investing allows your money to grow over time. If you leave $100 in a savings account, you might earn a few cents in interest. But if you invest that $100, it has the potential to grow into much more through the power of compounding and market growth. Example: imagine you invested $100 in the stock market 10 years ago. With an average annual return of 7%, that $100 would now be worth around $196. Not bad, right? Before diving in, it's crucial to understand the basic types of investments. Here's a quick rundown. Stocks. When you buy a stock, you're purchasing a small piece of a company. If the company does well, the value of your stock goes up, and you can make money by selling it later. However, if the company struggles, the stock price can go down. Example: you buy one share of Apple stock for $100. If Apple's stock price rises to $150, your investment is now worth $150. Bonds. Bonds are like IOUs. When you buy a bond, you're lending money to a company or government, and they promise to pay you back with interest. Example: you buy a $100 bond with a 5% interest rate. After 1 year, you'll earn $5 in interest, so your bond is now worth $105. Mutual funds and ETFs. These are collections of stocks or bonds. They're managed by professionals and offer diversification, which reduces risk. Example: instead of buying one stock, you buy a mutual fund that includes 10 different stocks. If one stock performs poorly, the others might still perform well, balancing out the risk. Now let's get into the practical steps of starting your investment journey with $100. Here's a simple guide. Step 1. Choose an investment platform. First, you need a platform to invest through. There are many options available, including apps like Robinhood, Webull, and M1 Finance. Look for platforms with no account minimums and low fees. Example: Robinhood allows you to start with as little as $1, making it a perfect option for beginners. Step 2. Understand your risk tolerance. Your risk tolerance is your ability to endure losses. If you're okay with high risk for the chance of high returns, you might invest in individual stocks. If you prefer stability, consider bonds or ETFs. Example: a 20-year-old might take on more risk by investing in tech stocks, while someone closer to retirement might stick with bonds. Step 3. Decide on your investment strategy. You can choose between a hands-on approach, where you pick individual stocks, or a hands-off approach, where you invest in ETFs or mutual funds. Example: with $100 you might buy a fractional share of a big company like Amazon, or invest in an ETF that tracks the S&P 500, spreading your $100 across 500 companies. Step 4. Make your first purchase. Once you've chosen what to invest in, it's time to make your purchase. Enter the amount you want to invest and confirm the transaction. Congratulations, you're now an investor. Example: if you decide to invest in an ETF, you could allocate $100 to buy a share or a fractional share, depending on the price. Investing doesn't end with your first purchase. It's important to monitor your investments and stay informed. Here are a few tips. Reinvest your earnings. If you make any profits, consider reinvesting them to take advantage of compounding returns. For example, if your $100 investment grows to $110, reinvesting that $10 can further increase your potential returns. Diversify. Don't put all your eggs in one basket. As you save more money, try to invest in different types of assets to reduce risk. For instance, after investing in stocks, you might later allocate some money to bonds or real estate through REITs or real estate investment trusts. Stay consistent. Consistency is key. Even if you can only invest small amounts regularly, over time, it can lead to significant growth. For example, investing an additional $10 each month can add up quickly, especially when compounded over several years. Finally, let's discuss some common pitfalls to avoid: chasing high returns. Avoid the temptation to chase after investments that promise unusually high returns. If it sounds too good to be true, it probably is. For example, an investment that promises a 50% return in a month is likely a scam or extremely risky. Trying to time the market. Even experienced investors struggle to time the market. It's better to invest consistently rather than trying to predict market highs and lows. For example, instead of waiting for the perfect time to invest, start with what you have now and keep investing regularly. Overreacting to market volatility. Markets go up and down. Don't panic and sell your investments during a downturn. Stay focused on your long-term goals. For instance, if your $100 investment drops to $90, remember that markets recover over time, and selling at a loss locks in that loss. Starting your investment journey with $100 is not only possible, but can be incredibly rewarding. Remember, the key is to start small, stay consistent, and keep learning. If you found this video helpful, give it a thumbs up, subscribe to Toppy-Do Insights for more finance tips, and hit the notification bell so you never miss an update. Thanks for watching, and happy investing. Check out these other videos to continue your financial education. See you in the next one.